Today, flip-flopping markets signal more uncertainty ahead. Hello again, it's Martin North from Digital Finance Analytics, one of those posts covering finance and property news with a distinctively Australian flavour. Ahead of the US holidays, we now know Jerome Powell will still be heading the Fed with an inflation noose around his neck. More oil is being pulled from strategic stockpiles, while the global supply chain machine continues to stutter from queuing ships, trying to unload, a shortage of pallets and containers, trucks, warehouse space and drivers. No surprise then that bond rates rose, tech stocks dropped, and bank stocks lifted. And meanwhile in New Zealand, they lifted the cash rate again. The Monetary Policy Committee there agreed to raise the official cash rate to 0.75%. They said the committee agreed it remains appropriate to continue reducing monetary stimulus so as to maintain price stability and support maximum sustainable employment. They went on to say that the level of global economic activity continues to rise, supported by accommodative monetary and fiscal policy settings and the relaxation of COVID-19 health restrictions. The pace of global economic growth has ebbed, however, due to the elevated uncertainty created by the persistent COVID-19 virus. Global supply chain disruptions are causing both cost pressures and constraints on production at a time when consumer demand remains strong, and central banks globally face the challenge of distinguishing between transitory price increases and underlying sustained inflation pressures to assess the need for and timing of reductions in the level of monetary policy stimulus. I think that's a very good summary, actually, of what's been going on. But of course, raising rates like that will translate into higher mortgages, and that will hit a number of people who are highly leveraged. So last night, the Nasdaq ended lower for a second straight session on Tuesday, while the S&P 500 rose. Those rising Treasury yields prompted investors to sell Tesla and other big tech names and buy stocks with lower valuations. The S&P 500 Growth Index dipped 0.3% and the Value Index climbed 0.8%. The Dow Jones Industrial Average rose 0.55% to 35,813, while the S&P 500 gained 0.17% to 4690, and the Nasdaq dropped 0.5% to 15,775. Treasury yields extended gains as investors ramped up expectations of interest rate hikes next year after Jerome Powell was nominated by President Joe Biden as Fed chair for a second term. Market-implied forecasts for inflation have in fact fallen back from record highs set earlier this month, and traders have upped their pricing of tighter policy next year, as officials including Richard Clarida have signalled that the Fed might increase the pace at which its bond purchases are easing. US headline inflation, fueled in large by supply chain disruptions and policy stimulus last month, leaped to 6.2% year-on-year. That's the fastest pace in 3 decades. And the so-called break-even rate for 5-year Treasury inflation-protected securities, which is a proxy for the anticipated pace of consumer price gains over the period, fell as much as 4 basis points to 2.97% on Tuesday. Expectations of a more hawkish central bank and a recent pullback in oil prices have helped lower the 5-year break-even inflation rate from a mid-November peak of around 3.25%, although markets continue to price inflation that's much hotter than the Fed's target range. In response to the apparent hawkish shift by officials, rate markets are now close to pricing in 3/4 points of tightening for 2022, and that move this week has helped drive yields on 2- and 5-year Treasuries to levels not seen since early 2020. In the meantime, investors will be keenly focused on upcoming consumer price inflation and non-farm payrolls data to see if they do indeed pave the way for the Open Market Committee to shift policy at its meeting next month. At a minimum, the prospects for an accelerated tapering will be on the table in December, with the probability tied to the upcoming NFP and CPI releases, wrote Ian Lingram, strategist at BMO, in a research note. Tesla fell over 4%. And Microsoft lost 0.6%, with the two companies dragging on the Nasdaq more than any other stocks. Rising interest rates tend to make growth stocks less attractive to investors. After closing on Friday at its highest level ever, the Nasdaq has now lost about 1.8% and it remains up 22% over the year. The market is being whipsawed by a holiday-shortened week, and it's taking its cue from the recent uptick in interest rates, giving investors additional reasons to take profits in an overvalued market, said Sam Stovall, Chief Investment Strategist at CFRA Research in New York. With banks benefiting from higher interest rates, the S&P 500 Banks Index jumped 2%, with Goldman Sachs, JP Morgan, and Bank of America all rallying. An IHS Markit survey showed US business activity slowed moderately in November amid labour shortages and raw materials delays, but remained comfortably in expansion territory on the strength of the manufacturing sector. But Zoom Communications fell more than 14% after warning of a slowdown in revenue growth as the pandemic-fueled boost to user growth is expected to slow as employees return to the office. While we're positive on Zoom's strategic initiatives and investments in key growth areas, we find it tougher to like a stock with more sharply decelerating growth and incremental pressure on profitability, Deutsche Bank said in a note, as it slashed its price target on Zoom to $280 from $350. Best Buy slid 12% after the electronics retailer forecast fourth quarter comparable sales below expectations due to supply chain issues. And chip makers Micron Technology and Western Digital rose 1.85% and 6.3% respectively after Mizuho Bank upgraded the stocks to buy from neutral. The US stock markets will be closed on Thursday for the Thanksgiving holiday, and it finishes early on Friday. Energy jumped more than 3% as oil prices rallied, despite President Joe Biden saying on Tuesday the US will release 50 million barrels of oil from its strategic petroleum reserve in tandem with other major oil-consuming countries to curb rising energy prices. It will take time, but before long you should see the price of gas fall where you fill up your tank, Biden said on Tuesday. Oil prices rose to a one-week high after a move by the US and other consumer nations to release tens of billions of barrels of oil from reserves to try to cool the market. But the interesting question is, why did those prices rise? Well, first off, a move like this had been well telegraphed. News reports speculating on potential releases from the Strategic Petroleum Reserve and talk of a coordinated effort that would include China and others circulated in recent weeks, and they were widely cited as a factor in crude oil's pullback in price from 7-year highs last month. But there's more to the bounce than traders simply fading a piece of long-anticipated news. An analyst said the size of the US release at 50 million barrels was larger than the 35 million barrels that had been widely anticipated, said Rob Hayworth, Senior Investment Strategist at US Bank Wealth Management. But details of the plan, including the use of swaps, which means oil's purchase from the SPR must be returned in the next 1 to 3 years, may have blunted the impact somewhat, he said in a phone interview. The reality is the impact is going to be modest, and the story will be one of what is demand going to do, Hayworth said, noting that transportation data, including US Transportation Security Administration airline passenger numbers, remains robust. Hayworth said demand was unlikely to be significantly deterred by a rise in COVID-19 cases and renewed restrictions in Europe, noting that recent upticks in cases hadn't put lasting pressure on oil demand. So how much crude is set to hit the market? Well, noting that India has already announced plans to release 5 million barrels, while Japan is expected to release around 4 million barrels. Participation by China, South Korea and the UK will bring the total number of barrels set to be released to about 65 million to 70 million. It's our understanding the administration is looking to keep prices below $80 and believe they have the ability to do another release of similar magnitude through the exchange mechanism, the RBC analysts wrote. They are keenly focused on reducing gasoline and diesel prices ahead of the holidays, but also see this as part of a broader strategy to deal with inflationary pressures and supply chain challenges. Some analysts, though, were underwhelmed by the overall scope of releases. South Korea, Japan and the UK were expected to release details of their plans in coming days, while traders also awaited word from China. The market is up on the lame nature of the US swap program, the small numbers actually involved, and the lack of commitment by the Chinese, said Robert Vega, Executive Director of Energy Futures at Mizuho Securities. And then there's the OPEC Plus, the Organization of the Petroleum Exporting Countries and its allies. The coordinated US-led effort has been widely described as a pushback by energy-consuming countries against the group's sway over crude prices. It comes after calls by Biden and the administration officials for OPEC Plus to speed production increases were rebuffed. OPEC Plus has instead stuck to a plan to slowly raise output in monthly increments of 400,000 barrels a day. How OPEC Plus will respond is a market wild card. Oil futures rose on Monday after Bloomberg reported that OPEC Plus officials were prepared to rethink planned crude increases in the event of a coordinated release from strategic reserves. OPEC Plus ministers are due to hold a monthly meeting next week. Tuesday's price action, however, could make OPEC Plus less likely to put on the brakes. If the coordinated release pushes prices below last week's lows, OPEC Plus would likely consider taking action, but today's price action tells us that they can wait and see, Hayworth said. And the RBC analysts also said staying the course remains their base case for next week's OPEC Plus meeting, but said they wouldn't entirely rule out the possibility that Saudi Arabia could call for scaling back production increases in response to the coordinated release. However, several Gulf states with close ties to the US would likely oppose such action out of fear of political blowback from Washington. The volatility index was up 1.1% to 1938, which is a new one-month high. Gold futures for December delivery was down 0.89% to 1,790, and of course below that 1,800 benchmark. Crude oil for delivery in January rose 2.64% to 78.78 a barrel, while the euro-US dollar was up 0.13% to 1.1249, and the US dollar futures index was down 0.05% to 96.49. Now, Bloomberg did a good piece on the complexity of the supply chain problem. I think we should look at it as one giant global machine. They look specifically at the twin ports of Los Angeles and Long Beach. That's the most essential gateways for the American economy over the past century, as the country expanded its economic reach beyond Europe and more towards Asia. But recently, if you name a supply chain issue, the two West Coast hubs that account for almost 40% of the country's imported goods are likely suffering from it. It's easy to understand the crunch at the Los Angeles and Long Beach ports when you consider its massive scale and the intricate process of moving containers from ship through its gates and back. The port sits on a combined 7,820 acres of land, have more than 150 cranes for moving containers and almost 50 terminals. Together, they welcome 3,600 vessels and handle around 17 million 20-foot equivalent containers a year. A bump in any step of the process can grind everything to a halt. Ships making the 2 to 3 week voyage across the Pacific are forced to spend just about as much time again waiting in line in Southern California before they're allowed to dock and discharge payloads of thousands of containers. The bottleneck means companies that hire the shipping lines to move their goods have to place orders several months in advance, pay much higher rates, and often order in larger quantities than they would have in the past to ensure enough inventory is on hand. The time it takes for goods originating in Shanghai to reach their destination through the San Pedro Bay ports has more than doubled to 62 days since January 2020, according to freight forwarder Flexport. Meanwhile, it currently costs $10,000 to $15,000 in the spot market to ship each 40-foot container from China to the West Coast. That's more than 5 times the pre-pandemic rate. While turbocharged consumers are among the few engines of growth that are healthy enough to pull the economy out of its pandemic funk, the supply side is straining to keep up. Increased demand for imports hits a wall when there aren't enough truckers or warehouse workers. At the same time, late arriving ships, old infrastructure and stretched rail networks, combined with pandemic workplace restrictions, have further complicated matters. The point is this: a global transportation system linking factories to consumers wasn't designed to operate for long periods at peak capacity, as the trans-Pacific trade lanes have been doing. The system reached its breaking point in November, and though officials are optimistic the worst may be over, it may take months more to untangle. Today's delays begin before ships even pull into a berth. What started a year ago with half a dozen container ships that dropped anchor in the bay nearby has ballooned into a maritime parking lot that currently exceeds 70 vessels waiting an average of more than 18 days. Ships are unloading much more slowly than usual because the containers that are hoisted onto the docks aren't moving inland fast enough, instead sitting on port property for weeks as warehouses and container yards across the region overflow. See, there's nowhere to unload the containers. The e-commerce boom fueled by the pandemic has meant more cargo entering the US than ever before. But once dock workers unload containers full of Asian-made goods, the lack of yard and warehouse space to store them often leaves the metal boxes with nowhere to go. A ship has a limited amount of time at berth, so dock workers often try to load both empty and full containers onto the ship while the import boxes are coming off. With empties crowding the ports as they await export, there's little room for the arriving freight. In an effort to incentivize companies to clear cargo fast, the twin ports announced a fee on ocean carriers that fail to clear containers off the docks. Since they unveiled the plan in October, the number of containers sitting on the docks has dropped by around 30%, the port said last week. The San Pedro Bay ports generate more than 170,000 jobs in the cities of Los Angeles and Long Beach alone, and almost 3 million positions countrywide. The more than 9,000 longshoremen, clerks and foremen working at the twin ports are on the front line of the supply chain, having moved almost 17 million 24 equivalent units so far in 2021. But with international longshore and warehouse union contracts expiring next summer, negotiations could throw a wrench in plans to clear the backlogs. The last time contracts were discussed in 2014, West Coast ports faced months of slowdowns that only got resolved when the White House got involved. For now, the unions say it's fully focused on moving cargo quickly and safely, according to Bloomberg. But there's also a shortage of chassis because containers can't move on their own. A shortage of truckers and chassis is also making matters worse. The US is currently lacking around 80,000 drivers, according to the American Trucking Associations. At the same time, chassis are also scarce, with many stuck under empty containers, while tariffs have made it more difficult to import new ones from overseas. The chassis available at LA Long Beach are managed by what's called the Pool of Pools, an agreement between three major operators with a fleet totaling more than 56,000 of the trailers, serving 11 terminals and 4 local rail facilities. The latest readings on their utilisation rates are hovering at the highest levels of the year. And empty containers get loaded back onto ships. Roughly 4 in 5 containers leaving the port of Los Angeles are now empty, up to 3 in 5 pre-pandemic. The carriers are expediting them back to Asia so they can charge high rates for the US-bound journey. In October alone, more than 335,000 empties left the nation's largest maritime hub, bringing the number of empty containers exported in 2021 so far to 3.3 million. Before the pandemic, carriers had more flexibility to wait until they could fill some of the empty containers with American goods before shipping them back to Asia. But with containers piling up fast and officials threatening to impose fines on metal boxes that stay idle for long periods, companies have felt the pressure to get rid of empty containers. And of course, trucks line up to get the goods out of the port. In a bid to move cargo in and out of the twin ports faster, California officials opened the 20-mile-long Alameda corridor in the early 2000s to serve as a freight expressway for trains and trucks. 3 decades later, the corridor can't fully accommodate the thousands of trucks that navigate the region every week. As a result, heavy-duty trucks often drive by residences and schools to avoid congestion. Sometimes truckers will go as far as abandoning containers and chassis in those same streets. In Wilmington, a blue-collar community located in the port's backyard, more than 400 illegal parking citations have been issued so far in November, according to the Los Angeles Port Police. But residents say the citations, which range from $73 to $98, aren't enough. It's like the Wild West, said Gina Moritz, co-chair of the Wilmington Neighborhood Council. The 54-year-old says the majority Hispanic community has been grappling with traffic since at least the port began expanding a decade ago, but that the ongoing supply chain issues have made things worse. Containers just keep coming in, she added. And then, of course, another key factor clogging the supply chain outside of port is the warehouse crunch across Southern California, where vacancies in the existing 2 billion square feet are near 1%, and rents have jumped 30%. In the Inland Empire development east of Los Angeles, about 20 million square feet of new space is under construction in a market that still needs 50 million to meet demand. So why is there such a deficit? Well, more supply chain problems, of course, including delayed shipments of building materials like doors and conveyor belts that are stalling construction. While smaller businesses get caught up in the Southern California port snarls, larger companies are coming up with alternatives to avoid the twin hubs. In a race to beat supply chain bottlenecks, some big box retailers like Walmart and Target began chartering their own vessels, filling all-time high holiday inventories. At the same time, Amazon.com has been relying on alternative gateways from California's neighbouring port of Oakland to as far as Houston in the Gulf Coast. But these increased shipping costs will likely translate into fewer discounts for consumers. As the holidays approach, and once abstract supply chain issues materialise as lower inventory and higher prices, consumers who barely noticed ports before the pandemic grow wary of the impact disruptions are having on their daily lives. Almost 2/3 of Americans are now saying snarls will impact their Black Friday shopping, according to the research firm Tuluna. But the snarls, port directors, officials and specialists alike all say these issues are likely to be way beyond this Friday. This, of course, all has real-world consequences. For example, Gap on Tuesday blamed significant supply chain constraints as it cut its full-year earnings guidance and reported third-quarter results that fell short of expectations. Supply constraints in the third quarter included COVID-related factory closures and continued port congestion, according to the retail chain. Acute supply chain headwinds affected our ability to fully meet strong customer demand, said the chief executive. Accelerated use of air freight to serve customers this holiday season, calling it an international investment in building enduring customer loyalty. So their shares fell significantly, closing at $23.47. Third quarter net sales rose at the company's Old Navy, Athleta brands compared with the same period in 2019, while decreasing at its Gap and Banana Republic brands. Analysts surveyed by FactSet had forecast earnings of $191 million or 50 cents a share on revenue of $4.43 billion. And the company now expects its reported full-year diluted earnings per share to be 45 cents to 60 cents, which it said includes an estimated $550 million to $600 million in lost sales because of supply constraints and about $450 million in air freight expenses for the year. Gap expects adjusted full-year diluted earnings per share in the range of $1.25 to $1.40, falling short of analysts' expectations of $2.15 a share. Gap stocks had gained about 15.5% so far this year, while the S&P 500 index has seen a 24% rise so far. So this is a real-life consequence, an example of what happens when the supply chain disruption comes home to roost. And that's the point, really. We are at a very important inflection point now with what's going to happen ahead. But higher rates in New Zealand, supply chain constraints continuing, and the threat of higher interest rates in other places too suggests to me that we're not out of the woods yet. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.